Welcome to the Power and Market Report on the Sprott Media Network. My name is Albert Liu. I'm your host. I'm pleased to be joined today by Whitney George. He is the portfolio manager of the Sprott Focus Trust, and he joins me by phone from his office in Darien, Connecticut. Whitney, thanks for joining me on the Power and Market Report. How are you?
I'm great. Thanks, Albert. I'm happy to be on the phone with you today.
It's a real pleasure to have you on, Whitney. And to start, I just want to talk about the interview you did recently with Rick Rule here in California a few weeks back. It was a very interesting interview, and anyone who didn't get the original transcript from our e-letter is invited to write to me at editor at sprottmedia.com. It's a 16-page transcript of an interview you did with Rick Rule, just brilliant stuff. And what I enjoyed the most is that you both share a value investing background. Rick, of course, has focused on natural resource investing for his entire career. You have done more of the traditional value investing approach, yet you do find value in natural resource stocks. I'll just throw that out for you, because Warren Buffett, he does not pursue these types of investments. And one of the questions Rick asked you was, what's going on here? Why the divergence in views? Can you talk a little bit about that to start?
Sure. Well, I think, what Rick and I both share is a combination of a very long-term outlook towards investments and understand that everything has its cycles and they come and go, and there's a long history that you kind of pick up with some experience of mean reversion that works out quite well. In the commodity space, it's often said that the best cure for low prices is low prices, and the worst thing for the best way to get rid of high prices is sustain high prices. So that's clearly true in the resource area, but it's true in a lot of things. And I think Rick and I are also somewhat contrarian. And I think I mentioned in the article my favorite Warren Buffett expression about becoming fearful when others are greedy, when others are fearful. And again, that plays into the long term. I find it very hard to predict what's going to happen the next few days, next few weeks or months. But I think it's a lot easier to make intelligent judgments over what's going to happen in the next 3 to 5 years. And I'm sure that Rick shares some of that with me. Warren Buffett is fascinating. I've spent most of my career studying, reading his annual letters, reading books about him. More often than not, you're better off doing as he does, not necessarily as he says. It's probably not well known or long forgotten that at one point in, I think, the late 90s, 96 maybe, Warren Buffett owned 130 million ounces of silver, which got my interest because I was wondering, what's up given what he'd said about resources, but it certainly piqued my interest in the late 90s, early part of the century. So it's not necessarily something he'll never do. Clearly, he's got a lot of people scratching their heads right now with his purchase of Apple and his ongoing purchases of IBM, because he always said he didn't understand technology stocks. I think one of the important things about being a good investor is one has to be adaptive. And I think one has to be prepared to, try and understand what one can understand and have a very open field of vision in terms of what sort of things that you might, try and learn about or might be interesting.
Whitney, there's so much in what you just said. First off, I've heard it said by Rick Rule and others that the cure for high prices is high prices, and vice versa. That also can be said for anything that's produced by human beings and exchanged by human beings, I would imagine. But the other thing is your comments on Warren Buffett about him really not being an outspoken advocate, actually the opposite, right? Being a critic of metals, yet purchasing them. Sometimes when he does things that people don't understand, the explanation is that there's someone else within Berkshire who is making those purchases. Is that the case with silver? How much did you look into that?
No, he was running the investment portfolio on his own in the late 90s. And again, I suspect that he owned a position in silver in the mid-single digits, and it would rally into the low double digits, and he probably sold call options against it and played that a number of times. And then ultimately, when silver broke out from $12, I'm trying to remember when that was, early 2000s, the position magically just disappeared. And my hunch has always been that the options he had written against his position, were exercised, and away it went. So it's not something that that people have really studied. He does make an interesting point about gold, being something that you find in the ground and then spend a lot of money digging out of the ground only to put it back into the ground, i.e. in vaults, as being sort of a silly exercise. But again, a lot of the junior resource stocks that I have looked at, some which I own, do just that. They find it and leave it in the ground, and they let somebody else come along and gamble. They'll get great by digging it out. And so have their exploration kinds of companies. They're identifying the finding the value, which is of course what I'm always trying to do in my. And so I can identify with that. If some millions of ounces of reserves knew that they existed, I don't care who you are. That's value creating.
Brings to mind an interesting image of Warren Buffett writing call options on precious metals to make it more colorful while traveling in a private jet. would be an interesting picture. I want to talk to you about something else, about his avoidance of technology and his investment in Apple and other companies. Could it be that these technologies are just mature enough that it's a comfortable investment for him? After all, you can think of a railroad at one time was a technology investment. Now we consider it infrastructure. Is that sort of what's going on now?
I think so. I think Apple in particular, one could argue is a consumer products company, more than it is a technology company. Now they do spend massive quantities on R&D to be, at or near of technology to have desirable products. But I'm sure, like me, he was attracted to the free cash flow generation that the business has inherently, and also their capital allocation. Their stock is statistically relatively cheap, and they've been using free cash flow and then some of their balance sheet to buy shares back, at the same time returning some in dividends. So I think it probably checked a bunch of the boxes. He got over the fact of it doesn't matter figuring out whether iPhone 8 is going to be a hit or not. They are building a franchise, or have built a franchise, that is formidable, and that shows up in the margins and the free cash flow that the business generates, even after spending multiples on R&D of what their competitors would spend.
Whitney, some people are referring to Apple more like a luxury lifestyle brand now. Do you see that angle?
Yes, I definitely see Apple as more of a consumer products kind of company. They spend vastly more on R&D developing new, innovative, products that people like and will pay a premium for. But at this stage, it's the ecosystem that they have built, the way they control your life once you're an Apple customer, with your information in their cloud and photographs, music, all of the applications. So it's more and more a service business, less and less dependent on hot new devices. Although, given the way they spend money on R&D, I'm sure they'll have plenty of interesting things for us all to get excited about down the road.
Right. I'm going to leave technology for a second, maybe circle back at the end of the interview, because I want to talk about some of your comments to Rick about your career. So specifically, when you were working as a broker, one of your biggest clients was Chuck Royce. And you talk about your experience following or in the 1987 crash. And this is one paragraph here where you're talking about not being able to get anyone interested in buying stocks. You got Chuck Royce on the phone. He's one of the only people that would talk to you. And he asks you for 5 stocks. You give him your 5 best picks. And he says, okay, buy me 10,000 shares down every 8th until they stop. This is who does things like that? I guess we should just explain what that means. But You
Sure.
can't run out of money, and you have to be sure these stocks aren't going to zero. Isn't that correct?
Well, if they all go to zero, what kind of career we're going to have in the money management business anyway. So I think Chuck, very experienced, understood sort of panic selling, when he sees it. The 87 crash was driven by a new innovation, portfolio insurance through futures on the S&P 500 and options on those as well. That went awry. So it's not too different. It was a predecessor to some of the sort of mini flash crashes that we've seen in the last 5 years or so. And there's always the possibility out there. Chuck had a good sense of what businesses were worth. He knew that I was buying or recommending companies that had very strong balance sheets. He might have had some knowledge about the companies I was recommending already without telling me. So I'm not the only person that got that kind of order from Chuck Royce on that day or that week. He understood how dollar cost averaging works. Back then, stocks traded in increments of an 1/8 point or 12.5 cents. That was kind of the bid-ask spread for generally liquid securities. And so today, an equivalent order would down every 10 cents or down every nickel or whatever increment one wanted to start with. Clearly, he had a large appetite, far larger than 10,000 shares. Nobody knew where it was going to end. But honestly, by the time I got the orders in, we were pretty well through the crisis to begin with. So at some point, all of this sort of exhausts itself, and when the crisis ends, stocks can go back up in the same kind of vacuum that they went down, and that's something he understood. So he didn't know where they would bottom, but he knew and believed that the cheaper he bought them, long run, the more attractive the purchase was going to be, and so entered orders that way. Again, 10,000 shares for him at the time, probably didn't represent a very large percentage of the money he was running. It was more stylistic than it was, a big order. In other words, he didn't say buy me 1 million shares or something. He just said buy small increments and keep on buying them until they stop. And sure enough, at the end of the day, his average price on all of his purchases was fairly nicely below the closing price on those stocks that day.
Right, so we have to put things in perspective, but still, you have to think about how bad things were at the time. And so I want to ask you, in your dealings as a stockbroker, until you stopped being a stockbroker, what percentage of investors, the professional investors, would you say had the courage to do something like that at a time like that?
It's a fairly small minority. It's not something you can necessarily be taught in school. It's something I've described to people as something only experience can help you obtain. In 1987, I thought the world was coming to an end. I was happy to get anybody on the phone, and certainly happy to get an order. But the firm I worked for went out of business 2 days later and had to sell their seat on the New York Stock Exchange. Point I left out in my interview with Rick. And so we had to find a new home. So the financial impact of Chuck's order really didn't have much magnitude. Certainly in the 91 bear market, life was a little bit easier for me, having seen bear markets before. Each time you go through one, your conviction that there's the other side, which is a recovery, becomes stronger. And I think it just, that experience alone, just it creates a muscle memory that allows you to maybe react to crisis situations with a slightly cooler head than you might the first time you see it.
You eventually ended up working with Chuck Royce, and Rick asked you, what differentiated you guys? You guys were obviously good at sales, but it takes more than that to create the type of track record that you've had, the success you've had over that period, a long period. And you said, this is interesting, you said it was a portfolio manager-driven culture, where the portfolio managers run the organization, so everything is done around accommodating them. And I've worked in organizations like that too in my other career, and this is kind of like something I've always wondered about. The sort of sales obviously is a skill and a talent of its own, but then the company has sort of specific talents. So it's talent versus sales. Which is more important? Which do you want the culture to kind of reflect? And in your case, you seem to think that it's the talent, the portfolio talent. Can you talk about that a little bit?
Well, I mean, I think what do you put first, the marketing of a product or the creation of a product? And it kind of gets to who's running the show. So when I say that we had a portfolio manager-centric culture, what I meant is we created products that we thought were great products that we invested first and foremost our own money in, not dissimilar to the way Sprott is run these days. And then if it worked out, then clients would find us. That's opposed to other asset management organizations who are run by marketing executives, and their job is to go figure out what will sell. So you start with the client. What does the client want? In the last few years, it's been yield. So go start some REIT funds and utility funds because that's what the client wants to buy. So at the end of the day, it's the client who's leading the investment process, at the start, as opposed to the investment professional. And so, very often products that we would start took 3 or 4, maybe 5 years before anybody discovered them. But once they discovered them, we had many happy shareholders who stayed for many, many years, as opposed to chasing the next marketing concept.
It seems like the latter, chasing marketing concepts or the whims of the investor, may produce very good short-term, immediate results, but then would leave you exposed to the crash when the trend necessarily reverses course. Do you agree?
I agree. I mean, money chases performance, and it's a lot easier to sell somebody a product and make a commission if everybody knows at the cocktail party that that's something cool that you want to own. That very often is precisely the moment where a risk manager, somebody who cares about preserving capital when things are tough and making it when the opportunities are there, might want to retreat. Now, that's not a very popular marketing decision because the people who make money selling things for their lives want to sell as much as they possibly can. But again, it's chasing performance. And of course, if you come chasing performance from one cycle to the next, you're going to come in closer to the top than the bottom and leave closer to the bottom than the top and repeat and end up with a very mediocre experience.
Elsewhere in the interview, you talk about micro versus mega cap investing, and you make a good point here that micro cap investments take time to research as well. So if you're going to put in the time to do the research, you might as well research opportunities where you can put money to work. And that's, I guess, Whitney George speaking as a money manager. What if you were an individual investor and that wasn't a problem? Would you put your time instead into the microcap stocks?
Yes, I mean that's for me. It's the inefficient frontier, and I guess what I meant to say is for most, not including us when I was at Royce. Why not spend the same amount of time on a big company where it's easier to go and buy and sell large amounts and put the money to work, as opposed to having to be very patient, often spending years to accumulate a position that would be make a significant impact on the portfolio. But there's a payoff for doing that work. I think that's true for individual investors as much as it is, for larger investors. Obviously, it's very hard to run, to buy microcap stocks, which we used to define as 300 million or less, maybe 500 million now. If you're running billions and billions of dollars, it will take you forever to come and go, out of that situation because it didn't trade that much. And even if you end up with 10% of the company, it's not going to be a big position in your portfolio. So, size is an impediment for people to get into microcap stocks, but it's a vast universe, thousands and thousands of names, always something going on, lots of inefficiencies because they're not well covered. Just as it's difficult for portfolio managers to use them, it's even harder for the sell-side research, brokerage firms to make any commissions marketing them, and so they get overlooked. And when things get overlooked, there's often an opportunity to find something that's mispriced. So I've used microcap stocks and use microcap stocks in my portfolio. What I do is when you come to a point where you can get a mega cap company like an Apple at the same valuation, absolute valuation as a microcap, it makes a little bit more sense to go to the big one because it's likely to get discovered and when they turn it around, appreciate it faster than waiting for the microcap stock to one day get acquired by a bigger company.
Rick Rule makes a similar point with regard to natural resource companies. It's similar, but not the same. He says, small mines or small companies involve risks just like big ones, but small mines will never become large mines, even when successful. So for that reason, he likes to pursue the bigger opportunities within this smaller space. So kind of an interesting parallel. There's one question I wanted to ask you while that interview was going on. You mentioned companies that you like, companies that you don't like, and I'm wondering if Amazon.com would ever become a company that you like, because it is growing. You said the ideal company is something that is totally reinvesting its earnings, it's profitable, reinvesting, and also growing. And in some ways, Amazon fits the bill. I'm wondering if Amazon is anywhere close to becoming the type of company that you would be interested in.
Nowhere close, because they're basically investing in businesses that are very, very low return businesses, with the intent to one day dominate those businesses and then produce reasonable returns on that capital. But it's unclear, and every time you turn around, there's another initiative. They have some very good, high margin, wonderful businesses, that if, they decided to be in the service business, in the cloud business, for example, or, in their providing, merchants with, this marketplace, those are wonderful businesses. Getting into groceries and competing with UPS and FedEx for shipping, I don't think are particularly good businesses. So it's a mix, and someday it will shake out. Someday investors will want a return on their capital and lose a little bit of faith in Amazon's ability to just do whatever they want and have it work out great. And in that moment, you'll have to see, what they end up with, what businesses they keep, which businesses they decide aren't fruitful and divest or write off. And all of these companies have their moments. Apple was a high flyer forever. I started buying the stock the day after Steve Jobs died, because obviously people thought it was over. So, all of these growth stocks have a way. They're cyclical too. I think, again, as I mentioned, one of the things that could happen is if interest rates really actually go up, and there is a discounting mechanism now put on these companies in terms of what is their cost of capital versus zero, and what is the return they're getting on that capital, you might see a lot of today's high flyers have a reasonably meaningful correction. Some will make it, some won't. I'm sure Amazon will, because there are a lot of great businesses buried in there, but not at these valuations.
Whitney, I know you're not a fan of banking stocks, and that strikes me as one area where the companies are not making their cost of capital uniformly. Can you point to any other sectors where if interest rates were to rise to where, I guess, pundits and the Fed have their 3-year projection, that would not be making their cost of capital and would be victims like you've highlighted?
Well, there are lots of businesses that historically haven't been great businesses. Utilities would be a whole segment. They obviously move up and down with interest rates, but the underlying businesses of utilities over time have not been particularly profitable, and they have a high requirement to pay their shareholders, large dividends. REITs is another interest-sensitive area where you can find properties at that aren't REITs at 10% cap rates, but once they become a REIT, they trade off of that yield, and in most cases become, in my mind, fairly valued, and then subject to the whims of the interest rate environment. Banks, are just hard because they use a lot of financial leverage, and they don't have much operating leverage, even less post-crisis with the regulatory environment we've been in. They've essentially been regulated into utilities, and one of the problems with utilities of any sort is that there is always an agency out there protecting the consumers from shareholders should they get too greedy. And I'd just as soon not have that partner.
Let me flip this question around. Which industries do you feel have a good degree of interest rate insensitivity, meaning a robustness in an environment of rising interest rates?
Well, again, asset managers have been the financial stocks that I have always favored because, again, they don't require an enormous amount of leverage. In fact, they don't really need much capital at all. You just need to retain your people and your talent. But you got all the operating leverage to improving markets. And one would think that if your principal business was money market funds, a rising interest rate environment would be very helpful so that you could start to charge fees again, because it's very hard when interest rates are at zero to charge somebody a fee for the money market fund, as kind of one example. And again, it depends on why rates are rising. Certainly, if rates are rising because the economy is getting healthier and we're getting back to normal, industrial companies are going to do well. Materials companies are going to do well and have been. Technology has continued to do well. I mean, it depends on why rates are rising. If rates are rising because nobody wants to buy U.S. debt anymore, then we got a different kind of problem out there, and stocks aren't going to be a haven from anything.
Right. Okay. Let's conclude that. I want to talk to you briefly about this article in Bloomberg today. Private equity wins even when it loses thanks to debt markets. It's kind of combines our discussion with easy debt markets with the way you look at companies, and that is as businesses, not just as stocks. Your thoughts, I know that you've seen the article, your thoughts just on on private equity in general, because these firms, they're criticized endlessly for this, for basically milking the companies for their own benefit and then leaving the companies just in a scrap heap. But it seems like lately it's been getting worse. Is that true?
Well, I think the tailwind of 30 years of interest rates declining, has certainly been helpful to a leveraged buyout kind of model. I mean, if you can refinance continuously, no different than people taking cash out of their homes before the financial crisis, you can live pretty high on the hog, and if you're making your clients what appears to be a lot of money, you can charge a lot of fees. Private equity competes directly with small and microcap stock investing. It's kind of the same pool of money in terms of institutions, that is allocated to kind of those sectors. It's the advantage of private equity is there's no mark to market on the portfolio every day. So, if you're a pension, you don't have to sit there and see your results, daily, in the newspaper, like you would with a mutual fund. So people, sort of take some comfort in that and think that it is, different than the stock market. Well, it's different in the stock market in that there's no mark to market every day, and it's no different than when liquidity, dries up. It's going to become a very, very difficult business. And again, a lot of the companies they invest in get recycled. They get fees for doing all sorts of things. Occasionally it is a very helpful. Sometimes, and I know this as a value investor, a company gets themselves into a situation where it's going to take 3 to 5 years to get it fixed. And maybe it is better for them to be doing it, in privacy of private equity, and then return to the market when they've got their problem solved, which would be a very happy exit for the private equity firm that sponsored that. So there is a role for them to play, but like everything else, it tends to get overdone. And again, when a lot of money chases any kind of concept, the returns diminish. The practices become a little bit more difficult. And again, leverage is something that, cuts both ways. And, we've had a tailwind for the use of leverage for a very, very long time, excepting maybe the financial crisis.
It is one thing to, for instance, take a company private to make the necessary changes and then sell that company later, either, I guess, in the public market or by some other arrangement. But what do you think about basically using the debt market to fund dividend payouts, and then later watching the company struggle long after the private equity firm has reaped the benefits of it? And I'm thinking about Mervyn's in particular, which is one company that was highlighted in the article.
Well, there are two things. There's retailing, and then there's there private equity deals that don't work out because they got too aggressive about refinancing and pulling cash out. They're trying. Portfolio private equity managers are trying to generate a demonstrable return to their investors, and lacking the ability to sell a company, recapitalizing it and pulling cash out is one way to generate a return. Now, if that ends up being overly aggressive and results in bankruptcy, that should be expected. Retailing is particularly interesting, and we touched on it earlier because some of the examples about and difficult areas in retailing right now in the private equity world, and actually in the public stock market as well, is that retailers don't really give you a true picture of their liabilities. Because they don't have to put their leases on the balance sheet. They're in the footnotes, but if they owned the stores, they'd have to finance them, and it would be on the balance sheet. But by controlling stores through long-term leases, they basically have assets that they're just paying a small interest rate or rent on that allows their returns to look a lot better. But when things go wrong, those leases suddenly become obligations, because if you have to close stores, you have to settle up with your landlords. And so their balance sheets end up looking a lot worse than anybody thought, if they were just looking at the annual report or public documents.
Can you talk about then the related practice of taking a retailer like Sears or Mervyn's and splitting out the real estate holdings into a separate firm?
Well, that's a clever way to get some of the assets in the case where they actually own properties, or they have very attractive leases that they could easily get out of profitably. That's just stripping out value. I mean, Sears, started shorting Sears in 2007, and if it weren't for such a massive short position and short squeezes and everything else, I'd still be there. But they're doing a masterful job of gutting that company. At the end, the shareholders certainly will end up with nothing, and a lot of the bondholders will end up with nothing, and the clever financiers will end up controlling valuable real estate, which somebody else can come along and do something else with. So that's been a slow death march now for at least a decade. And to compound the problem, and again, this is the problem. If the turnaround takes too long for private equity and they're stripping money out as opposed to reinvesting, it compounds. The stores get run down. Nobody wants to go there anymore. You can only do that for so long before it becomes evident and the spiral starts to accelerate.
Talking about these retailers like Sears brings to mind JCPenney as well, and it's kind of fashionable now or trendy now to rip on Bill Ackman. I don't know if you've noticed that with some of his investments going south. Were you ever a believer in the JCPenney turnaround story?
No, but JCPenney was kind of too big for me to look at. I had plenty of turnaround stories in retail, Claire's stores, Once Upon a Time Dress Barn, which is now Cena. I still own the Buckle, the brass Buckle, which is primarily a denim, blue jeans, and tops kind of store chain around the country. I mean, I don't dislike retail. I just think you have to be very careful with the accounting. I think our economy right now is not, in a favorable position. Consumers are still quite strapped, and so results have been difficult. I think the kind of online sales are growing. I don't think that's really, the death knell of traditional retailing, and people still need to try things on. But, it can be difficult, and turnarounds can be difficult, and particularly if someone is not, prepared to be patient and take the right steps, re-merchandise, maybe change some leadership. do some business things as opposed to stripping out assets.
Do you think, and this is obviously a massive speculation, but just the big department store model now is facing headwinds from online retailing and whatnot that are just going to be, in the long run, too difficult to overcome? So Macy's, Sears, JCPenney, all of those stores?
There's some good retailers that have, done the combination correctly. The people don't believe that, there's still a huge catalog business out there. And, online has really cannibalized the catalog business more than it has the in-store business. At the end of the day, if somebody's online, they have to have a delivery system for you to get the merchandise. And so setting up warehouses all over the country, is one way to do it, but, using your stores more proactively as distribution centers for online sales and bringing people into the stores can work very nicely. I mean, I think there's I never say never, I think there's a good combination out there of doing two or all three of those kinds of merchandising and, under one roof.
Very good. Whitney, we got to go now, but I want to thank you for joining me, and I want to remind you, people watching this video, you really want to check out this interview between Rick Rule and Whitney George. Just a lot of great insights here. You can get it if you didn't receive it in the email. By email, you can request it specifically by emailing editor@sprottmedia.com. I'll make sure you get a copy of that. Whitney George, thank you very much for joining me. It's always a pleasure to speak with you, and I look forward to doing this on a regular basis.
Please, I would enjoy nothing more. Thank you.